Hey everyone, welcome into another edition of Market Takes. Today we are breaking down the latest PCE inflation report. If you don't know what that is, you haven't been watching enough Market Takes. I'm your host Dion, Rabouin, reporter at the Wall Street Journal. We're looking at inflation today because, as I keep saying, and I'm going to keep continuing to say it until it's no longer true, if you're watching the markets, if you're watching what's going on with the economy, if you're watching your investments, your 401k, what's going on with your job, it's all about inflation. It keeps coming back to inflation. And today's report, PCE, the Personal Consumption Expenditures Report, is the Fed's favorite inflation gauge. But it's not about the data so much today. You know, we're all about data here on Market Takes. But today it's all about thinking about how the Fed might interpret the data, because there's a lot here for interpretation. So, of course, we're going to talk about what the PCE report said and how that compared to expectations. We're going to talk about the big takeaways from the report and also how the Fed might interpret those. We're going to check in on the markets to see how investors and money managers, traders are interpreting this data, because we did get a pretty sizable reaction to the data today. We're going to talk about the overall current state of inflation and what we learned from this report. And we're going to talk about how this aligned with other data we've seen, because, of course, no report on economic data comes out in a vacuum. It's all about context, it's all about what's happening overall. And, of course, as we always do, we will talk about what comes next, because we are always looking forward here on Market Takes, even though it is backward-looking data. So let's get into it. Let's talk about today's report, PCE inflation in January. Let's throw a chart up here on your screen so you can see what I'm talking about and what I'm looking at. Here's what we got. So starting in 2021, you see inflation starting to rise up there well past the Fed's 2% target. Early on, the Fed was saying transitory. We think this will go away. And then inflation rose to about 7% in the summer of 2022. And since then, it's come pretty consistently down. You see it picks up there kind of towards in Q3, Q4 of 2023. But since then, we've come consistently lower, and you see those low readings. And then today, in January, we found out PCE inflation 2.4%, up 0.3% month over month, right on the numbers of the expectations. Expectations were for 2.4% year over year growth, 0.3% month over month. So right in line, down from 2.6% the previous month. Basically, what this tells us, inflation is coming down and it's coming back towards that 2% target. I'm gonna see if maybe our graphics team can get a yellow or a red line on that 2%, because that's what it's all about. It's all about inflation getting back down to 2%. That's what the Fed wants. That's the Fed's target. And they've said, we're not taking 3%. We're not going to accept 2.5%. We want 2%. Fed Chair Jerome Powell has been pounding the table like I just did, and the Federal Reserve has been saying the same thing there in line. But really what you see here in this chart just illustrating that inflation is coming down. It's moving back towards the Fed's 2% target. That's a good thing. It's a good thing in terms of prices. It's a good thing for the market. Inflation coming down, cooling towards 2% is an overall objectively good thing if you're an investor, if you're just out here in the world trying to do some shopping, right? Throw another chart up here on your screen so you can see core PC. When you strip out food and energy prices, core is holding up. Now, when you take out food and energy prices, the Fed does this because those can be very volatile. They move around a lot from month to month. But the trend that we've noticed recently is that energy prices has been bringing overall inflation down. So you see core was at 2.4, overall inflation for PC was at 2.4%. We see core at 2.8%. So you see the same kind of trend with inflation consistently moving lower. But what we are seeing is kind of the same thing, where it's holding up here right around 3%. On CPI, inflation's holding around 4%. But on PCE, which is the report we got today, inflation holding up around 3%. Higher than overall. And so when you take out energy prices, which because energy prices are coming down so much from last year, what you're seeing is that core PC is holding up stronger than overall. This came in very close to the numbers, or right on the numbers again, and down from 2.9% the previous month. And again, this just illustrating the overall trend for inflation moving lower. But when you strip out food and energy prices, which are two things that have really been holding inflation higher, when you take those out of the mix, you do see inflation up more than you do when you don't. And so the question is, how will the Federal Reserve interpret this data? Because overall, what it tells us is inflation is coming down. But what we have seen is some nuance in those numbers. And what we're seeing is core prices holding up, which is supposed to be what the Fed is most focused on. Because what the Federal Reserve says and what Chair Jerome Powell says is this gives us the best idea of what inflation is going to do, about where inflation is headed. Gives us the best idea of what our policies can actually control. The Fed raises, lowers interest rates. They can also create money and give it to the banks. But that's another story for another live stream. What we're talking about right now is the Fed favors looking at core PCE because they feel like that gives them the best insight into what's going on in the economy. Now, the details on this report are very interesting and want to get into a couple things. Really, one of the most important, I thought, was that this report shows that inflation is cooling, but maybe inflation's cooling just a little bit too much. Might be a little too cool, a little cold, like, oh, a little colder than we'd expect. Real disposable income decreased 0.1%. Real PCE also decreased 0.1%. Household outlays rose 0.2%. That's the smallest increase in 3 months. Very small increase. And so it's possible what we're seeing is some weakness from the U.S. consumer. Now, that matters because what we had seen all of last year really was this surprising strength. Really, I compared it to the U.S. consumer being in the weight room. Well, if we're looking at this data, what we got today, looks like the U.S. consumer might be skipping leg day a little bit. Might be just in there working those beach muscles. That's not how you get strong. And so what we're seeing is a little bit of weakness overall, 0.2% outlays, and a lot of that came from the big pickup in income. We're going to talk about that in just a second. But overall, what we are seeing is PCE inflation coming down. It's coming down more than CPI, and it's been lower pretty consistently. We're seeing PCE getting back towards 2%, but we are seeing that core number holding up higher. One thing you're starting to hear, one thing I'm starting to hear a lot more of, is economists and asset managers saying the Fed needs to get to cutting. Rates need to come down, and they need to come down sooner than later. We had, again, remember, there were expectations coming into this year that we were going to get cuts in March. That meeting's coming up in about 3 weeks. I think it's almost 3 weeks to the day yesterday that the Fed's next meeting. And folks were betting on rate cuts as soon as then. That's been wiped off the table by Fed Chair Jerome Powell and by the data that we've gotten. So no one's expecting rate cuts at this meeting. But the question is, do they start to set up for their next meeting? Or are they pushing this out? And we will hear from the chairman very soon. We'll talk about that in just a second. But big trend right now I'm hearing from economists and asset managers is the Fed needs to hurry up and cut interest rates because the economy is starting to feel some stress. And you do see that in this report. So the big question is just how are they going to interpret it? Let's jump into the numbers. Let's nerd out a little bit and dive into these numbers. Personal income up 1%. That was significant. That is a big increase. Usually you're seeing personal income up 0.2, 0.3%. 0.4% or 0.5% is a pretty big increase. We saw a 1% increase in personal income in this month. That is significant. Now, here's where it gets a little tricky because most of that increase wasn't just people are making more money, they're earning more at their jobs, people just have more money. Most of that increase came from transfer payments, aka government payments. So compensation was actually only up 0.4%. But transfer payments, aka government programs, was up 2.6%. That is significant. When you see a chart on this thing, it jumps off the chart when you're looking at like a 1 or 2 year back period. It's usually like, kind of like, and then this month, whoo, that January increase. So it is significant. Social Security payments, specifically Social Security. So that's not a huge segment of the population. It's also not a segment that's inclined to spend a lot of money. Social Security payments up 3.5% on the month. To give you an idea of transfer payments being up 2.6%, the last few results are 0.1%, down 0.2%, down 0.2%, down 0.2%, and 0%. So when you see this increase of 2.6%, that jumps off the chart. That's one of those things that you look at, you're like, wait a second, what happened here? And the big increase was transfer payments and largely Social Security. So what we're seeing is a lot more income to certain Americans, to a small segment of Americans that don't spend that much money. My man Lou Breen, he's the economic strategist at DRW Trading. He talked me through that this morning. We had a little email conversation, but I thought that was really interesting, a really interesting piece of this data. So one thing potentially holding inflation up could be these transfer payments, but these transfer payments aren't going to big spenders. Lower income Americans are the biggest spenders in terms of when they get money, it usually comes back right into the economy. Upper income Americans, older Americans, they don't do that. When they get an increase in spending, generally they put it into savings, they put it away. they're generally on a pretty fixed schedule in terms of spending, and that's what we've seen. So biggest takeaway right now is just the Fed has a lot to think about. This report wasn't a slam dunk. It wasn't a smoking gun. It didn't give us a sense of, okay, inflation's falling, the Fed's got to cut interest rates. It also didn't give us a sense of, all right, well, inflation is staying too high, too hot, Fed's got to hold on. This is really going to be all about interpretation and what the Fed thinks. So are they ready to start cutting? Are they ready to say, hey, we're ready to lower interest rates? Or are they going to say, you know what, we need more time? So watch out for Fed speak over the next week or two, because that could really move markets. I know a lot of folks aren't really used to tuning into New York Fed President John Williams speeches, or when the chairman speaks, or just yesterday we got Boston Fed President Susan Collins was talking. But these next couple weeks could be big in terms of Fed speak, in terms of what Fed speakers say, members of the Federal Reserve really moving the markets in a significant way, especially the bond market. Chair Jerome Powell is going to be testifying before Congress on Wednesday, that's March 6th, presenting the Monetary Policy Report to the U.S. Financial Services Committee. Watch out for that. That could be a big day, because the Fed chairman is likely going to sort of tip his hand a little bit, say, hey, you know what, I'm biased in favor of raising rates, or not raising rates, excuse me. I'm biased in favor of cutting rates, or I'm biased in favor of holding right where we are at this 5.5% rate that really we know historically makes the economy struggle, especially over the last 20 years. We haven't seen anything this high. Rates right now, the highest they've been in 23 years. Listen, let's check out the market while we're talking about it. Let's see what's going on in markets overall. You see the Dow has just turned negative. We are seeing the Dow turning lower. And really, we opened up a little higher, but now we're seeing the Dow turn lower off the start of the day. And what you see right there is the S&P also turning lower, still positive, but we are seeing markets really have a bit of an about face over the last half hour or so. Let's take a look right now at bonds, though. What we're seeing from the bond market is, as you see here, the yield change is just going down pretty consistently across the board. Not big moves, but what we did see was as soon as the report came out, you saw bond yields move lower pretty significantly and consistently across the board. You saw the same thing. We see the WSJ dollar index right here rising about 0.26%, so significant moves. Also, big moves for Bitcoin in the cryptocurrency space. You're seeing Bitcoin up 4% right now, Ether up 4.5%. Big, significant moves in the crypto space. Not really sure that's related to this PCE inflation report, but maybe, you never know. Other thing we are seeing is commodities. Crude oil futures rising right now, gold futures up. All these things are priced in dollars. So when the dollar weakens, which is what we're seeing because bond yields are coming down, you see commodities really start to rise. And the most significant increase we're seeing right now is in gold. Gold up about 0.8%. And you see on the chart there really just spiking up higher. That's really what we're seeing across the market, is a big response to this PCE inflation report. And that just illustrates, again, the way the market has been taking this report. It's in essence saying, okay, we expect this is going to give the Fed what they want to start cutting rates and what they need to justify rate cuts. We shall see. Again, the chairman speaks Wednesday, March 6th. That's going to be must-see TV there. Must-see TV. Be there or be a... That's a square. Don't do it. That's the big picture. Listen, really quickly, let's get into the details again. Real disposable income and real personal income both decreased. Real PCE decreased 0.1%. Household outlays only up 0.2%. So households are starting to get a little bit of spending fatigue. We've talked about right here on Market Takes, disposable income has been negative for lower income households for 5 or 6 quarters in a row. We've talked about the savings rate for those lower income households has been negative, as in they're spending more than they're saving, as in money is coming out faster than it's coming in. So those lower income segments of the country are struggling and have been struggling for quite some time. And we're starting to see that show up in the overall data. Another big piece of this report is we saw goods spending decrease 1.1%. So again, goods are bringing down overall inflation, but services increased 0.4%. So what you're going out spending at restaurants, bars, what you're paying your lawyer, your plumber, your house renovation people, those things are getting more expensive, especially insurance, car insurance especially. Those prices rising. Personal savings rate still historically very low, something to keep your eye on, but again, we've talked about how those lower income households are really struggling. We're seeing, again, services up, goods down. Will we see that continue, and how does the Fed interpret that? That's going to be the big question. Big things within this report I think we should talk about. Housing prices continue to rise. That was one of the things that was spotlighted in this report, was the increase in housing and how that held up. You're going to want to watch the latest existing home sales reports. Homes are going to be a big piece of this because we're seeing home sales continue to rise. We're seeing overall prices rise. Even as rates rise, we're seeing sales pick up, and the housing market seems to be back. So we'll see if that continues. That could put more upward pressure on inflation. Durable goods orders dropped. So again, overall what we're seeing is prices going up, spending going down, consumers looking a little tapped out. One report does not a trend make, but this one report combined with some other data that we've seen, like the durable goods report, like that U.S. retail sales report we got earlier in February, which was negative 0.8%. We are seeing a bit of stress on the consumer, and we're seeing a bit of stress out there in the market. So what comes next? Well, next week, jobs week, baby. Not just the U.S. non-farm payrolls report, the jobs report, as we all like to call it. The JOLTS report, job opening and labor turnover survey, that's out next week as well. And be sure and check those reports out. Watch for the Fed chairman Wednesday, March 6th. And for more, check out my podcast, WSJ's Take on the Week. We cut through the noise to explain the major business and financial news that moves markets, all so you can make smarter investing decisions. Check that out wherever you get your podcast, WSJ's Take on the Week. We're doing it there too. So listen, that's going to do it for us here on Market Takes. I'm Dion Rabouin, reporter at the Wall Street Journal. Please come back and join us when we do it again next time.